In this class, we're going to talk about fundamental concepts, risk and return. These are at the core of financial models and decision-making. Managing and measuring risk is the kind of problem that shows up in many contexts. For example, think about an investor saving for retirement. One can adopt a safer strategy, providing a higher likelihood of reaching a target, but a lower upside. Or an investor can pursue a riskier strategy, invest more in equities, for example, providing higher likelihood of an upside, but also a higher chance of falling short. A hedge fund needs to decide how to allocate capital across multiple investment strategies. This depends on the risk of individual strategies, which has to be measured and managed, as well as the joint distribution of returns on multiple strategies. An insurance company, which sells multiple types of products, life insurance, casualty insurance, has to decide how to model the joint distribution of risk. How do you quantify the risk at the firm level? Is it the case that individual insurance contracts are roughly independent and risk can be diversified? Or is there a common component which is going to translate into firm-level risk? A sovereign wealth fund, when formulating an investment strategy, needs to be aware of how financial risks are related to the underlying risks of the country's economy. All of these problems are examples of risk measurement and risk management. In order to make decisions under uncertainty, we need an analytical mathematical framework. In this class, we're going to introduce the expected utility theory. This theory quantifies decision-making under risk and can be used as a basis of portfolio choice in particular. We are going to develop analytical tools for quantifying risk, for measuring it, and apply them to investment decisions. This all comes under the broader umbrella of portfolio analytics. We will also introduce the concept of diversification. Diversification is a process of eliminating risks by pooling investments into a portfolio. Many call diversification the only remaining free lunch in financial markets. In this segment, we'll talk about the expected utility theory. So let's start with a basic decision problem under uncertainty. Suppose you're choosing between two gambles, gamble X, gamble Y. Gamble X allows you to win $1,000 or to get nothing with 50-50 odds. Gamble Y gives you a 70% chance of winning $600 or 30% chance of winning $200. Which of these choices is preferred? Now, a naive approach would be to compute expected payoffs and then choose the higher one. But what about randomness? What about risk? We know that a 50-50 gamble of winning $1,000 or getting nothing is not the same as getting $500 for sure. Most people are averse to this kind of risk. How should we quantify the trade-off between expected payoffs, uncertainty, variance, or other properties of the payoff distributions? That is the question that we are going to answer. There are two general approaches to building models for decision-making under uncertainty. Let's call them rational and behavioral. The rational approach, which is what we are going to pursue in this class, is prescriptive. It's a model of choice which gives us consistent decisions under uncertainty. This internal consistency is desirable. It's basically a way of avoiding costly mistakes. A behavioral approach has a different objective. Rather than figuring out what is the right, consistent way of making decisions, the behavioral approach aims to describe how individuals make decisions in all of their imperfections. For example, if you're an investor, you're trying to avoid mistakes in your portfolio choice, you would want to use a rational approach to make sure that your own decision-making is consistent. If you're a financial advisor, thinking about how to best advise your clients, you may want to understand what behavioral biases are most relevant and help your client correct them. If you're a trader, thinking about what other traders are doing in the market, whoever is taking the other side of your trade, understanding behavioral biases could be at the core of your profitability. So we're going to proceed developing a model of consistent decision-making and we'll call it a rational model. Our model is going to make a few basic assumptions. We are going to think about preferences over outcomes only. Outcomes in our case are cash flows. This is important. It's a restriction which could be relaxed, but under the basic model, we are going to make this assumption. What this means is that we are going to think about the value of the payoff, $100, $1,000 payoff. We're not going to think about the circumstances under which the payoffs are realized. That is a more general problem. We will also model preferences in a way that is independent of how cash flows are generated. Randomness may come from many sources. It could be algorithmically generated. It could be a natural outcome of economic forces. At the end, our preferences are going to be developed to deal with the distribution of cash flows and not with the mechanism for generating randomness. These are the two basic assumptions that we're going to start with. We're going to maintain them. The expected utility theory, which we're going to present next, is at the core of the rational approach to decision-making. It's the leading model for decision-making under uncertainty. Under the expected utility theory, investors do not use expected payoff of a gamble to compare gambles to each other. They don't think about just the mean of the return. They don't think about the expected payoff of an investment. They think about the entire distribution. Expected utility theory applies a transformation to the payoff. It's a nonlinear transformation. For example, a $1,000 payoff is not going to be perceived as twice as valuable as $500. An investor, depending on his or her preferences, is going to adjust the internal value of each payoff, the utility of each payoff, to reflect their preferences. Once the payoffs are transformed nonlinearly, as you can see in this graph, the probabilities of payoffs are then applied as weights. So under the expected utility theory, an investor evaluates a particular risky investment based on the expected utility, where the utility, evaluated as a function of outcomes, is averaged using probabilities of different events as weights. For example, if you're faced with a binary gamble and the curve presented on the graph, the blue line, is the utility function, the gamble has only two possible payoffs, either 1.2 or 2.8, both equally likely. The utility of the payoff is going to be given by the dot in the middle of the segment, connecting the two dots on the utility curve. This is a graphical representation of the expected utility of this particular gamble. An investor transforms payoffs using the utility function and computes expected value of the utility. That's the starting point. That's the description of uncertainty and how the investor feels about different risky outcomes. Now, the consistent approach to choice is to compare risky investments to each other based on their expected utility. When thinking about investment A versus investment B, whichever yields higher expected utility is preferred. That is the expected utility theory. This approach is mathematically parsimonious. It's fairly intuitive, and it helps avoid costly mistakes. It respects laws of probability. It leads to investment decisions with some basic desirable properties, such as transitivity. For example, under the expected utility theory, if an investor prefers X to Y and Y to Z, the same investor will correctly prefer X to Z. Next, we're going to develop a concept called risk aversion, or to be more precise, relative risk aversion. This is the key property of the utility function, which reflects the property of investor behavior. How averse is this investor to risky outcomes? We're going to start with the basic fundamental properties of the utility function itself, some desirable properties. For example, if we want the investor to prefer more to less, which is very common, mathematically it's going to imply that when confronted with a choice between gamble X or gamble X plus positive epsilon, the investor is going to prefer X plus epsilon. What it means is that to capture preferences like these, preference for more to less, an investor would have to have an increasing utility function. So far so good. Utility function has to be increasing. What more can we say about its shape? As it happens, if an investor is averse to risk, the utility function also has to be concave. Now, why is that? Suppose an investor is presented with a risky gamble, X. The choice is take the risk, play out, gamble X, collect the outcomes, or receive a sure thing, a payoff without risk equal to the expected value of X. Between X, random, expected value of X, sure thing, what would the investor choose? Now, most investors are averse to risk. They would rather collect a sure thing, a fixed payoff equal to the expected value of the gamble. Mathematically, it means that the utility function has to be concave. If the utility function is concave, then the mean of the gamble is always preferred to the gamble itself. To illustrate the concept of risk aversion graphically, and to see how this is related to concavity of the utility function, look at the graph. The blue line is the utility function, plotted against the outcome of the gamble. This function is concave. Now imagine that we're playing a binary gamble, as before. Two outcomes, 1.2, 2.8. Both outcomes are equally likely. If the investor evaluates this gamble using the expected utility model, the expected utility is going to be seen on the graph as the dot in the middle of the red segment. This is the line connecting 2 points, utility of 1.2, utility of 2.8. Now, this is the expected utility of the random payoff. What if instead the investor was presented with the sure thing, the expected value of the gamble? In this case, the expected value is 2. The utility evaluated at the expected value of the gamble is shown as the blue dot on the utility curve. The blue dot, of course, is above the red dot. It has to be because the utility function is concave. This is the essence of what a concave function is. So what we can see is that based on this graphical representation, it's quite clear that concavity of the utility function is equivalent to risk aversion in behavior. Now we're going to develop a concept of risk premium. Suppose that an investor is evaluating an investment strategy with return X, which is random. An investor starts with wealth W, invests, and collects a payoff equal to W times 1 plus X. Let's assume that the expected return is 0, and we are going to call the variance of returns sigma x squared. The risk-averse investor, of course, would prefer to receive a 0 return for sure, a risk-free return of 0, rather than playing this gamble, rather than making this investment. Now, we're going to define a concept of risk premium as a number, pi. It's a fixed number, it's not a random variable, such that an investor would be indifferent between collecting a return of minus pi or investing into a strategy with a risky return x. To determine what pi is, how it reflects the properties of the utility function and the risk of the gamble, we need to think about investors' preferences. Being indifferent between investing into an asset with a random return x versus getting a sure risk-free return of minus pi means mathematically that expected utility of w times 1 plus x is equal to the utility evaluated at w times 1 minus pi, which is a riskless return of minus pi. To analyze this equation further, we need to make some approximations. We're going to use a Taylor expansion to simplify the problem. So to start with, let's assume that the range of outcomes of this gamble, the support of the return, x, is relatively narrow, so that the range of possible outcomes of x is concentrated somewhere around 0. Let's say between minus and plus epsilon, where epsilon is a small number. If that is the case, then the risk premium, pi, is going to be small in magnitude as well, which allows us to use a Taylor expansion to approximate the problem. With this idea in mind, we're going to expand both sides of the equation around 0. Let's start with the left-hand side. Expected utility of w times 1 plus x. We are going to expand it around x equal to 0. First, let's expand the utility function under the expectation. We are going to keep 3 leading terms in the expansion. First, utility of w. Then, the marginal utility, u prime, evaluated at w times x, That's the linear term in the Taylor expansion. Then comes the second order, or quadratic term, 1/2 of the second derivative of u times w squared times x squared. When we take the expected value of this expression, we are left with utility of w, u prime times w times the expected value of x, which by assumption is 0, plus, and here's the important term, 1/2 of the second derivative of u times w squared times the variance of the return, which is sigma x squared. This is the approximation of the left-hand side, the expected utility of the risky return. On the right-hand side, we have the utility of w times 1 minus pi, which we also expand. Here we only need to keep the two leading terms, 0 order and the first order. We end up with u of w minus u prime times w times pi. We end up with an equality. On the left-hand side, we have an approximate expression for the expected utility of the risky investment. On the right-hand side, it's the utility of w times 1 minus pi, the certainty equivalent, which defines the risk premium. When we solve this equation, we see that the risk premium is given by minus 1/2 times the ratio of the second derivative of the utility function times w divided by u prime of w times sigma x squared. We see that the risk premium is a product of two objects. The first is what we call the relative risk aversion coefficient. This is minus w times the second derivative of the utility function divided by the first derivative. This object captures what we know as the curvature of the utility function. If the utility function were to be a straight line, the second derivative would be 0, relative risk aversion would be 0. For a properly concave utility function, this number is positive. The second piece, the second term in the risk premium, is the measure of return risk. In this case, we see that it's return variance. The conclusion is that the risk premium that investor demands, based on the riskiness of the gamble, of the investment strategy, and based on his or her own preferences, is comprised of two terms: investor's relative risk aversion, which is the property of the utility function, and return variance, which is the measure of return risk. Let's consider a couple of examples of utility functions. First, the simplest case is a linear utility. In this case, u of w is an affine function of w. Linear utility is special because it implies zero relative risk aversion. An investor with linear utility does not care about risk. This kind of investor is going to evaluate each investment opportunity based on the expected value of the return. The second example of the utility function that we want to introduce is the so-called power utility function. It's also called constant relative risk aversion. We will see in a second why this name. A power utility function is given by a power function of investor's wealth, and its coefficient is a positive number. The case of the coefficient equal to 1 is special. In this case, the utility function becomes logarithmic. The key property of the power utility function, and the reason why it's so commonly used, is that the relative risk aversion coefficient of this utility function is constant. It's equal to the exponent in the power, and it's independent of the level of wealth. The implication of this is that an investor following a power utility function is going to have the same risk aversion regardless of the level of wealth. Which means that making an investment decision with $1 million or 5 or 10, this investor is going to choose the same portfolio of investments. The level of initial wealth doesn't affect the choice. Next, we are going to introduce a special class of preferences called the mean variance preferences. These preferences are very important. They are at the core of the modern portfolio theory. They're highly tractable, and we are going to base a large part of our discussion of portfolio choice on this model of preferences. Let's assume that returns on all investments are normally distributed. This means that for any investment we are willing to consider, the distribution of returns is Gaussian with the investment-specific mean and variance. Let's call them R bar and sigma squared for a particular investment under consideration. An investor following the expected utility model is going to rank investments based on their expected utility. Let's compute expected utility of a normally distributed return. It's going to be a function of the two moments, the mean and the variance. As a result, this investor is going to evaluate each investment using only these two moments, the average return, the mean of the investment return, and the second moment, the variance of the return. Hence the name, mean variance preferences. Variance of returns, or standard deviation, which is the square root, is the only measure of risk under this model. An investor compares all investments based on their two key properties, the first two moments. We should know that this model of preferences is special. It applies to many situations. It produces useful results, but it's not a complete story. It is, however, an important starting point, and it is very widely used. Now, the graph that you see helps us visualize investor preferences by plotting the indifference curves in the space of risk and expected return. In this case, we will think of risk as the standard deviation of returns, which is plotted on the horizontal axis, and expected returns are on the vertical axis. The curves that you see, the blue curves, represent indifference curves corresponding to a particular set of mean variance preferences. What this means is that the investor that we are thinking about is indifferent between any 2 points on the same curve. Moving in the vertical direction means increasing the expected return, moves us from one indifference curve to the next and to the next. So moving up is going to lead to higher levels of expected utility. Moving to the left means reducing risk. This again leads to higher levels of expected utility. When evaluating investment decisions, an investor with mean variance preferences will prefer investments that are represented by points as far as possible in the northwest direction, based on the shape of the indifference curves. We will now discuss the basic properties of asset returns. We'll look at some empirical data to get a sense of the level of risk and return in different asset classes, how they're related to each other. Let's begin with some notation. For any investment, the initial price, P0, is known. The terminal price, P1, at the end of the period, is random. It's unknown. A period could be a month, a quarter, a year, whatever is relevant for a given context. At the end of the period, there are additional cash flows that investment produces. Let's call them dividends. They're also random. As a result, the total return on the investment during the period, we call it R1, is given by the dividend plus the capital gains, which is P1 minus P0, divided by the initial value of the investment. So the total return comes from capital gains and the dividends, or more precisely, the dividend yield, which is the ratio of D1 to P0. The expected return is just the expected value of the return. It's equal to the expected dividend plus expected terminal price divided by the initial price minus 1. It is common to use the concept of excess returns. Excess returns are typically measured in relation to the risk-free rate. As the name suggests, excess return is the return in excess of the risk-free rate. So for each investment return, we can subtract the risk-free rate and we obtain a measure of excess returns. We will now introduce several basic statistics that are commonly used to describe the properties of returns. Under the framework of mean variance preferences, these are also the building blocks of how we describe preferences over different investment strategies. They capture the average returns and return risk or variance. In particular, we'll talk about investment return mean, R bar, the variance, sigma squared, and the standard deviation, which is sigma. Standard deviation is commonly called volatility of returns. These moments, which form the basis of preferences under the mean variance framework, are not known in practice. They need to be estimated. They can be estimated using statistical techniques based on historical data. The most common estimators the most basic estimators corresponding to these population moments are the sample mean, which corresponds to the population mean or average return, the sample variance, which is 1 divided by the sample size minus 1 times the sum of square deviations of returns from their sample mean, and the square root of the sample variance is the sample standard deviation. These are the most commonly used statistics that we are going to employ now to describe the properties of financial returns in the data. Let's look at a few examples of the major asset classes and their properties, their average returns, and their standard deviations. In particular, we are going to look at the history of returns starting in 1926. We will use annual data, and we'll be using nominal returns. The least risky investment in our table are the T-bills. This is as close as it comes to the risk-free rate in practice, and the T-bills have low volatility and low returns. The reason why they have any volatility at all is because the risk-free rate changes over time. It is not constant year to year. Next, in terms of the level of risk, come bonds, treasury bonds and corporate bonds. Their average returns are roughly twice as high as for T-bills, and their level of volatility is quite a bit higher, in the 8 to 10% range. Stocks are even more volatile than bonds. Volatility of stocks is in a 20 to 30% range, and it's important to understand what we mean by that. We are thinking about portfolios of stocks, either large cap stocks, this is a portfolio of companies with large market capitalization, or small caps, portfolio of stocks with a low market capitalization. These portfolios are the most volatile in our table. They have the highest volatility, 20-30%, and perhaps higher, and their average returns in sample are 12 to 17%. What we can see from this table is a pattern that suggests that when we compare different asset classes to each other, higher returns come with higher levels of risk. This is a casual observation. We need to learn how to better model the relation between risk and return, but this is the starting point. There is no free lunch. In order to achieve higher levels of returns, investors have to accept higher levels of risk. Now, the graph here represents visually how quickly different investments allow one to accumulate wealth. There are several lines here. Imagine you start with $100 at the end of the year 1925. You invest in a particular asset, T-bills, bonds, stocks, and you keep rolling over your investment over time. How quickly would your wealth accumulate? As we can see from this graph, there is an order of magnitude difference between outcomes at the end of this exercise, roughly a century later. Investments in bonds, long-term treasury bonds or corporate bonds, produce significantly higher levels of wealth compared to T-bills. Large cap stocks do even better, an order of magnitude higher level of wealth. Small cap stocks as an investment strategy do even better than that. This raises a question: why would any investor want to invest in bonds when in the long run stocks perform so much better? The answer lies in the risk-return trade-off. Investing in stocks in order to achieve higher levels of returns comes with a much higher level of risk. It is because of this risk-return trade-off that all of these investments can coexist. For some investors, stocks are more appealing. Those investors have higher tolerance towards risk. They're able to achieve higher levels of reward, higher levels of expected returns. For more conservative investors with lower levels of risk tolerance, investing in bonds, which are safer investments, is more appealing. We will now talk about other dimensions of return risk. We will try to think outside of the mean variance framework. For an investor, properties of returns other than return variance could be important. In particular, we can think about such moments as skewness and kurtosis. Skewness is a property of the return distribution that measures its asymmetry. A distribution that's skewed to the right will have the property that large positive outcomes are more likely than large negative outcomes. Similarly, if you think about negative skewness, then large negative outcomes are more likely than large positive. Skewness is particularly important when dealing with nonlinear investment instruments, such as derivatives. For investment strategies involving derivatives, return distribution is often highly skewed, and as a result, mean variance preferences do not completely capture all dimensions of risk that are relevant for the investor. Kurtosis is another feature of the distribution. It captures the measure of heavy tails or fat tails. A distribution with a high level of kurtosis has the property that extreme outcomes on the right or on the left are both relatively likely. In particular, they are more likely than under the normal distribution. When we think about an investment strategy with a high degree of kurtosis, we have to worry about the high likelihood of increased outcomes, which is an important dimension of risk. We also need to think about modeling risk. If a distribution has fat tails, the properties of the distribution, such as the mean and the variance, are relatively difficult to estimate. In the following table, we compare return moments, mean and standard deviation of two exchange-traded funds. First, let me remind you what the exchange-traded funds are. These are securities that trade just like stocks, and underneath these securities are portfolios, investment strategies, that follow a relatively simple recipe. These are funds, they're portfolios, but they trade as stocks. They're very convenient and increasingly popular investment vehicles. We are looking at two types of funds in this exercise. One is an equity fund with the ticker symbol SPY. This is a fund that tracks an S&P 500 index. The second fund is a bond fund. This is a bond ETF with the ticker symbol EGG, and this fund tracks a portfolio of bonds. The average returns over the past decade or so are around 0.7% for SPY and around 0.3% for EGG. In the table, you could see the average returns and the standard deviation of returns at a monthly frequency starting in January of 2008. The takeaway here is that the equity ETF, SPY, is much more volatile than the bond ETF. The ratio of volatilities is practically 4-1. Next, let's take a closer look at the distribution of returns on one of these funds. We are looking at the bond fund here. As we can see from this graph, there is a large outcome on the right. When we evaluate the likelihood of this outcome under the normal distribution with the same variance as the historical distribution of returns on this ETF, we find that this observation, which happens to come from December of 2008, is approximately 5.8 standard deviations away from the mean. If you recall, December of 2008 was right in the middle of the great financial crisis. How likely is this kind of observation? Under the normal distribution, one would have to wait on average 10 million years in order to see a draw of returns like this. What this analysis tells us is that the distribution of returns on the bond ETF is very far from normal. This is an example of high kurtosis. These types of outcomes are extremely rare under the normal model, yet we do see them in the financial data series. High kurtosis is a common feature in financial markets. Properties of asset returns are not constant. They change over time. This is very important to recognize when modeling the distribution of returns statistically. It also helps us understand some of the properties of returns, such as high likelihood of extreme outcomes, high kurtosis, relative to the normal distribution. Let's take a closer look at an exchange-traded fund. This fund tracks a portfolio of high-yield bonds. The ticker symbol is HYG. Again, we're looking at the time series starting in 2008. What we see from the graph is a pretty clear period of high volatility in the early part of the sample. This is the crisis period of 08 and 09. This is not surprising. As we know from history, this was the period of significant dislocation in financial markets, credit markets in particular. As a result, fixed income investment strategies, such as those represented by this type of fund, were extremely volatile. During this period, there were many months with high draws of returns, either large positive returns or large negative returns. To be specific, we observed 5 months with returns exceeding 3 standard deviations in magnitude, and that happened in a span of a single year. This should be extremely unlikely under the normal distribution with constant volatility. Of course, the point here is that volatility is not constant. This early period produced so many large observations of returns, precisely reflecting the fact that the market volatility was relatively high. What this example illustrates is that it is important to model time variation in return volatility in order to have a realistic model of risk. Risk is time varying. Having discussed the properties of individual asset returns, we will now talk about the joint distribution of returns. How can we describe interdependence of different financial assets? The core concept here is correlation of returns. It is a measure of dependence. It's a linear measure. It's not the only possible way of describing how returns are related to each other, but it's a leading statistic that's very commonly used. We start with the covariance of returns. A covariance is defined mathematically as the expected value of the product of the differences between returns on asset I and its mean and asset J and its mean. The correlation is just the covariance of returns normalized by the product of standard deviations. What this statistic captures is to what degree two assets can move with each other. When correlation is high, close to 1, both assets tend to go up and down in unison. When correlation is close to -1, they tend to move in the opposite direction from each other. When correlation is 0, there is no linear relation between the two assets at all. A closely related concept is the beta of returns. The beta is the ratio of the covariance between returns on asset I and asset J and the variance of returns on asset J. The concept of beta is very important. We're going to come back to it, but intuitively what the beta represents is the degree to which returns on asset J affect statistically returns on asset I. When beta is equal to 1, for each 1% movement in asset J, we would see on average 1% movement in asset I. When we plot returns on one asset versus the other as a scatter plot, beta is given by the slope of the regression line. The following graph provides a visual illustration of how joint distributions may look with positive, negative, or zero correlation. What you see in the top left corner is a scatter plot of the joint distribution of returns on two assets with zero correlation. It looks like a ball of points. There is no obvious linear relation between the two. On the right, we see two examples of imperfect correlation, a positive and negative. At the top, correlation is positive. It's equal to 0.5. We see visually a clear positive relation between two assets, which is not perfect. There is a lot of deviation from the 45-degree line, but nonetheless, it's clear that the two assets, on average, move together in a positive direction. Below that is a graph corresponding to the correlation of minus 0.5. Now we see that the typical relation between the two assets is negative. When one of them goes up, the other one tends to decline. At the bottom on the left, we see an example with a high degree of positive correlation. Now it is 0.8. We see that the points now fall very close to the 45-degree line, indicating that most of the movement is now highly related between the two assets. There is very little individual variation. Next, let's look at a couple of empirical examples, showing us the degree of correlation between different kinds of financial assets. On the left, we have a scatter plot illustrating the joint distribution of returns on two stocks. One is Intel, the other one is IBM. Both of these are large technology stocks. What we see from this graph is a clear sense of positive relation between the two. These two returns are positively correlated. This is not surprising and, in fact, fairly typical. Stocks that are economically related to each other will tend to have positive correlation. On the right, we see a scatter plot of two exchange-traded funds. We encountered them earlier, the bond fund, EGG, and the stock fund, SPY. It's a different picture. We now see that the distribution of points on the scatter plot does not show an obvious linear relation. The scatter plot looks like a random cloud of points, and the regression line is relatively flat. In this case, correlation between the two assets is very close to zero. Stocks and bonds have a low degree of correlation. This is an important empirical fact and forms the basis of long-term investment strategies, diversifying risk between stocks and bonds. We will come back to the concept of diversification later in this class. Let's take a look at a broader pattern of correlations among different types of financial assets. In the table, we look at pairwise correlations between stocks, bonds, treasury bills, and inflation. We see that closely related assets tend to have high levels of correlation. For instance, when we look at large cap stocks and small cap stocks, we observe correlations around 80%. Different types of equities tend to commove with each other. Corporate bonds and treasury bonds also show a high degree of commovement, over 80%. Stocks versus long-term treasuries, as we have seen before, don't have a lot of commovement, and their correlation with each other is close to zero. Treasury bills tend to have positive correlation with inflation. It's not terribly high, but it's in the neighborhood of 40%. The reason for that is that the nominal return on treasury bills has an inflation component, and that induces a positive correlation between the two. So far, we looked at the pairwise correlations between financial assets. We think of these as cross-sectional correlations, how returns are related to each other at a point in time. Another important dimension is time series correlation, or autocorrelation. This concept applies to a single asset over time. We are now looking at how returns during different periods are related to each other. The empirical fact in financial markets is that there is not a lot of serial correlation in returns. Autocorrelation or serial correlation of returns in most assets is very close to zero. This is the case for stocks and long-term bonds. The reason for that has to do with the fact that high degree of serial correlation would imply that it is relatively easy to forecast future returns by observing past returns. The two are closely related. Being able to predict returns on risky assets would then enable one to design highly profitable trading strategies. These are difficult to come by. As a result, the implication is that one should not observe high levels of autocorrelation in returns, particularly at high frequency, daily, weekly, or monthly. The following figure illustrates the point. We are now looking at the monthly returns on a stock. It's a stock of IBM, and the scatter plot shows returns in any given month against returns in a previous month. We see that there is no clear linear pattern on this graph, and in fact, the empirical estimate of the autocorrelation over this period, which starts at the beginning of 2008, is close to -6%. There is not a lot of autocorrelation in returns on this stock or most other risky investments. We will now introduce basic elements of portfolio analytics. In particular, we'll introduce concepts of leverage and margin. First, let's define a portfolio. A portfolio is a collection of assets, risky or risk-free. The portfolio is defined by its composition, how many shares of each security are held in the portfolio. In terms of notation, we're going to denote the total portfolio value by V, and this value is going to be equal to the sum of investments in each of the securities in the portfolio. Each of the investments is valued as the number of shares times the market price. So the total portfolio value, V, is equal to the sum across all of the positions in the portfolio of the product of the price, PI, and the number of shares, NI. The composition of the portfolio can also be described by portfolio weights. The weight on each investment is defined as the ratio of the value of the position normalized by the value of the portfolio. It's the ratio of NI times PI, which is the value of the position, over V, the value of the portfolio. For this definition to make sense, the value of the portfolio cannot be zero. In fact, typically the value is positive. There are, however, some portfolios for which the value V could be zero. We call these arbitrage portfolios. An arbitrage portfolio is special. It does not require a positive investment. For every long position in the portfolio, there has to be a short position so that the total investment into the portfolio is zero. For a typical portfolio, V is positive. Portfolio weights in this case are well defined, and by definition they have to add up to 1. So the sum of W1 plus W2 and so forth across all of the positions in the portfolio is always equal to 1. As an example, consider a portfolio of 3 securities, A, B, and C, with a total investment of 100,000. Suppose that we buy 200 shares of asset A, 1,000 shares of asset B, and 750 shares of asset C. You can see the relevant data in the table. We can see the number of shares in each position, the price per share, which is 50 for A, 60 for B, and 40 for C, and the total investment into each security. The total investment is equal to the number of shares times the share price. For example, for asset A, it's 200 shares at $50 per share, it's 10,000. It's 60,000 for asset B and 30 for asset C. So the total investment is 100,000. We can see in the column on the right, portfolio weights. As we said before, portfolio weight is defined as the ratio of the value of each position to the total value of the portfolio. For A, it's going to be 10,000 divided by 100, which is 10%. It's 60% for B and 30% for C. By definition, these weights sum up to 1 or 100%. Now, suppose your broker informs you that you could in fact maintain the same portfolio with less capital. Let's say you could reduce your capital investment to 50,000 from 100. How can you achieve that? You need to use margin. You could borrow money at the risk-free rate to buy risky assets in the portfolio. In our particular example, in order to buy $100,000 worth of stocks, starting with 50,000 in capital, you would need to borrow 50,000 at the risk-free rate. This changes the portfolio composition. If you now look at the table, you see that we have a new row, which corresponds to the risk-free bond. The investment into the bond is negative, which means that we are borrowing $50,000. The investment in each of the stocks is the same as before. We're establishing the same portfolio. The portfolio weights, however, now change. The reason is that while the investment into each of the securities, A, B, and C, is the same as before, the total value of the portfolio in the denominator is now 50,000 and not 100, which doubles the weight on each of the risky assets. It is now 20% invested in A rather than 10, 120% in B rather than 60, and 60% in C instead of 30. When we sum up portfolio weights across the risky assets plus minus 100% invested in a risk-free bond, the total of the weights is again 100%. Another example of a portfolio that is commonly used can be seen in buying real estate. Imagine that you're buying a house. The value of the house is 500,000. You make an initial investment of 100,000, which is 20% of the house value. These ratios are typical for the US residential market. The remaining $400,000 need to be borrowed, and they could be borrowed by obtaining a mortgage on the home. As a result, a buyer of the house has a portfolio with two positions: $500,000 of real estate, which is the value of the house, and a negative position of $400,000, which represents the mortgage. This is the amount of money that the buyer owes to the bank. The total net value of the investment, which is the value of the portfolio, V, is $100,000. It's the sum of the two positions. If we now compute portfolio weights, we see that the weight of the house, the weight of the real estate in the portfolio, is plus 500%, and the weight of the mortgage, which is a loan, is minus 400%. The total, again, is 100%. The ratio of the asset value to the net investment is what we call leverage. That's the leverage ratio. In our example of buying a house, the asset is the house, the net investment is $100,000, which is what the buyer of the home invests into this property. The ratio of the asset value to the net investment is 500 over 100, which is 5. That's the leverage ratio of this transaction. Leverage magnifies movements in the asset value. It scales up gains as well as losses. For example, suppose that the house value declines by 15%. A cash buyer would have seen a 15% decline in the total value of the portfolio. Someone who uses a mortgage is going to see a much larger decline. In fact, it's going to be 5 times as large, 75%. To see that, let's compute the decline in the asset value. 500,000, that's the value of the initial investment, declines by 75,000, which is 15%. Following the decline of 15%, the value of the house is now $425,000. With the initial investment of 100,000 and a mortgage of 400, this means that the buyer of the house is left with a total of $25,000. That is a $75,000 decline, or a 75% decline relative to the initial investment. We will now talk about risk and return in portfolio investments. In particular, we will introduce the core concept of this lecture, diversification. When forming a portfolio, why not pick the best asset among many possible investments? Well, there are many problems with this idea. One is, of course, it's hard to tell which stock is the best. It is also the case that by forming a portfolio of multiple investments, one can achieve a better risk-return trade-off than by picking one asset over another. That is the benefit of diversification, something we are going to discuss in detail in this segment. One can use a portfolio to enhance performance by focusing one's bets. This could be achieved by hedging. For example, suppose that you have a view on a particular company. Your view is on the quality of firm's management or on its opportunities in the marketplace. If you want to place a bet on a company, you are in fact betting on much more than your initial view. You are betting on broad market moves to which the stock is exposed. By taking additional positions, for example, by taking a short position in the market, you would be able to isolate your bet so that you are betting on stock-specific performance rather than on that plus additional movements in the market. So forming portfolios could be very useful in order to isolate views on particular elements of the trade. Portfolios can be used to customize and manage risks. This is an important part of the risk management process. They could be used to tailor risk-return trade-off to the needs of the particular investor. How do we go about choosing the best portfolio? Now, first of all, we have to say, what does the best mean? This is subjective. What we want to do is to find a portfolio that is the best for a particular investor, given his or her preferences. This process is an optimization process. Among all possible portfolios, we are going to look at the one that maximizes the investor's objective, such as expected utility. This means that before we form a portfolio, we need to agree on what the objective is. What are we trying to optimize? Which properties of the portfolio are important? Now, in the mean variance framework, there are two aspects of the portfolio that matter. One is the expected return. Investors prefer higher expected returns. The other important dimension is risk. Investors prefer lower risk, and in particular, risk is measured by variance of portfolio returns. Expected return on the portfolio, as well as the variance of returns, are determined by the composition of the portfolio, which is the collection of weights on individual investments, and by the properties of the individual investments themselves. In particular, when we think about the portfolio average return, the portfolio mean return, it is based on the average returns of individual assets and portfolio weights. If we put together expected returns on individual investments into a vector from 1 to n, call each of the elements R bar, which represents the expected return on each of the stocks in the portfolio, then the expected return on the portfolio is a sum over all of the positions of the expected return on an individual asset times the portfolio weight of that asset. In other words, the expected return on the portfolio is a weighted average of the individual expected returns. For portfolio variance, it's a bit more involved. First, let's summarize the information about the properties of the individual investments. This is no longer a vector, but a matrix. It's the covariance matrix. The diagonal elements of this matrix summarize riskiness of individual securities. They're given by the variance of security returns. The off-diagonal elements, which will turn out to be very important when we talk about diversification, capture co-movement of investments with each other. They capture covariance, pairwise covariance of assets in the portfolio. As an example, let's consider a portfolio of two assets. One is a ETF, SPY, it's an equity ETF. The other is a bond ETF, EG. We have seen these two securities before. In the following two tables, you could see historical estimates of average returns on the two securities, as well as their variance-covariance matrix. The variance-covariance matrix is not easy to read. It is more intuitive to present information as volatilities of individual investments, as well as their correlations with each other. As we have seen before, investment in SPY has much higher volatility than the bond ETF investment, and correlation between these two securities is very close to zero. Now, let's take a close look at the expected return on the portfolio. As we said before, the expected return on the portfolio is a weighted average of expected returns on the securities in the portfolio. Let's see why that is the case. We will do that by following a simple example. Again, two securities, SPY and EG. Suppose that we invest $600 into the equity ETF and $400 into the bond ETF. It's a $1,000 investment in total, and the portfolio weights are 0.6 on SPY and 0.4 on EG, respectively. Suppose that over the next month, the return on SPY happens to be 2%, and the return on the bond ETF, EG, is minus 1%. Keep in mind that these are realized returns over a particular month. These are not expected values. What is the total return on the portfolio? We can see that the portfolio value is going to change, and the change is going to be equal to the sum of changes in the values of the individual positions. The investment in SPY is going to increase by 2%, which is going to be equal to $12. The investment in EG is going to decline by 1%, which is a $4 decline. The total increase is $8 over 1,000, which gives us 0.8% return on the entire portfolio. What this illustrates is that the return on the portfolio is equal to the weighted average of returns on the individual positions. Once we know how the return on the portfolio is related to the returns on individual investments, we can compute the expected portfolio return and the variance of the return. The expected portfolio return is an expected value of the weighted average of individual asset returns, which ends up being the weighted average of expected returns on the investments in the portfolio. The unexpected component of the return can be computed by subtracting the portfolio return mean from the realized return. portfolio return variance is the variance of the weighted average of the individual security returns. Using the formula for the variance, we see that this amounts to summing up elements of the matrix that you see presented here, where the diagonal elements of the matrix are individual variances multiplied by the squares of security weights in the portfolio, and the off-diagonal elements are covariances of asset returns multiplied by the product of the corresponding weights. In case of two assets in the portfolio, we end up with three terms. Two diagonal terms, which capture the contribution of individual return variances, and the off-diagonal terms, which are identical to each other and capture the contribution of the co-movement between the two assets in the portfolio. Going back to our original example of a two-asset portfolio of SPY and egg, let's assume that the weights on the two securities are equal to each other. W1 equal to W2 equal to 1/2. In this case, the expected portfolio return is an arithmetic average of the expected returns on the two securities. A portfolio mean is always a weighted average of individual return means. Next, we compute the volatility of portfolio returns. For our portfolio of SPY and egg, we find that the portfolio volatility is in fact less than the weighted average of the individual volatilities of returns. This is an example of portfolio diversification. Volatility of the portfolio is not a simple weighted average of individual volatilities, and by combining securities together, one can achieve a significant reduction in risk. What enables us to do that is the imperfect correlation between returns on the individual positions in the portfolio. We now extend our results to the general case, a portfolio of n assets. This is analogous to the two-asset portfolio, except now we have a longer sum of terms, and the expressions are general. The portfolio return, as before, is a weighted average of individual asset returns. The portfolio mean is a weighted average of mean returns on individual assets in the portfolio, and the variance of the portfolio return is a sum, it's a double sum, over all assets in the portfolio, and each element of the sum is given by the product of security weights, Wi and Wj for assets I and j, times the covariance between their returns. If we look closely at the portfolio variance, we see that it can be decomposed into two types of terms. The diagonal terms capture the contribution of the own variance of each of the positions, and the off-diagonal terms that are driven by covariances. We will now introduce our main result, portfolio diversification. First, let's look at an example before we take a deeper dive into the analytics. Consider a portfolio of two securities. This time we're going to look at two individual stocks, IBM and Intel. These are both large technology stocks. We form a portfolio with equal investments in these two securities. When we compare the volatilities of individual investments on IBM and Intel to that of the portfolio, we see that the volatility of portfolio returns is lower than either of the two volatilities. By combining these two securities into a single portfolio, we are able to reduce risk. It is now lower than it would have been for any one of these two as individual investments. This is an example of what one can achieve by diversifying risk. It is intuitive why the risk of the portfolio may be relatively low. These two stocks, IBM and Intel, are different companies with their own firm-specific risks. They have a lot in common. They're both technology stocks. They're both exposed to macroeconomic news, but they also have individual components. By combining them into the portfolio, we're able to reduce the impact of individual firm-specific risk. When one of these stocks is up, for idiosyncratic reasons, the other one may be down. This kind of cancellation is what enables us to reduce the portfolio risk. More formally, we will see that a reduction in portfolio risk is based on the covariance of returns between the two assets. The following graph illustrates the concept of diversification. We start with two securities with identical volatilities, 35% in this case. We make several alternative assumptions about the degree of correlation between the two assets. One extreme case would be when the correlation is perfect, equal to 1. Most of the time correlation is imperfect, so we look at a few alternative values, 0.5, 0, and even a negative number, minus 0.5. What we see is that as the correlation between the two securities declines, the volatility of the portfolio gets progressively lower. This illustrates the power of diversification. The case of the negative correlation of 0.5 leads to the largest reduction in risk through diversification. Now let's step back and think a bit about the limits of diversification as a tool. What can we hope to achieve? Some of the risks are truly security specific, and by combining assets into a portfolio, we can hope to reduce the impact of these risks significantly. There are certain kinds of risks that are broad, that affect multiple assets or perhaps the entire market. These types of risks cannot be eliminated through diversification. As a result, there are two types of risks that we can distinguish. Diversifiable, these are the types of shocks that can be eliminated or significantly reduced through diversification by forming portfolios, and non-diversifiable. These types of risks survive portfolio formation. They are present even in well-diversified portfolios with many assets. There are several intuitive examples of important non-diversifiable risks. For example, business cycle shocks. They affect multiple businesses in the same direction. As a result, forming a portfolio of stocks does not help eliminate exposures to business cycle shocks. Inflation shocks are another example. They affect multiple assets in the same direction. A spike in inflation is going to affect a portfolio in the same way it affects individual assets. Shocks to market liquidity have a similar effect. Many securities decline in value when market liquidity deteriorates. Not all of them do. As we'll see in other classes, there are exceptions to this rule, and securities like US Treasuries tend to move in the opposite direction. What this tells us is that exposure to the common shocks largely affects financial assets in the same way, but not all of them have identical exposures. It's a relatively nuanced picture. Nonetheless, it is clear that shocks like liquidity shocks, inflation shocks, business cycle shocks are different in nature from firm-specific risks, which can be eliminated or reduced by diversification. Let's take a closer look at the mechanics of diversification. How does it work, and what are the limits to what we could achieve through this process? Consider an equally weighted portfolio of n securities. The covariance matrix of returns has diagonal elements, denoted by sigma ii. These are the individual variances of asset returns, and the off-diagonal elements, sigma ij, which give us covariances of returns, asset I versus asset j. To compute the variance of the portfolio return, we need to sum over all of the elements in the covariance matrix multiplied by the product of portfolio weights. In our special case of the equally weighted portfolio, all portfolio weights are the same. They're equal to 1 over n. What we see as a result is that the variance of portfolio returns is a sum of the diagonal terms. Each of them is equal to 1 over n squared times the variance of asset i's return, and the sum of the off-diagonal elements, which is a sum of 1 over n squared times sigma ij over all values of I and j that are not equal to each other. The key observation here is that in a large matrix, in a portfolio with many assets, there are a lot more off-diagonal elements than there are the diagonal elements. In fact, in case of n assets in the portfolio, there are n squared minus n off-diagonal elements. To put it into perspective, in a portfolio of 100 assets, there are only 100 diagonal elements, and there are almost 10,000 off-diagonal elements, 9,900 to be precise. When we put together all of the terms in the expression for the portfolio variance, we can see that the expression separates into two terms. The first is 1 over n times the average variance of individual returns. The second term is very close to the average pairwise covariance of returns. As the number of assets in the portfolio increases, the first term converges towards 0. The second term does not disappear. In fact, it converges to the average covariance of returns. What this result tells us is that in a well-diversified portfolio with many assets, variance of portfolio returns is determined by the average covariance of individual returns rather than by their own risk or their own variance. This tells us where the limit of diversification is. By forming a large portfolio with many assets and diversifying risk, we will be able to eliminate firm-specific risk, asset-specific risk, and we will be left with the average covariance, which captures the contribution of systematic risks, those that are common to multiple assets. To gain further intuition, let's plug in some numbers that are typical for empirical distributions of asset returns. On average, a standard deviation of a stock in the US stock market is close to 10% per month. A typical number for pairwise correlations is 40%. Using our previous expression, we can then compute the average covariance of returns in the portfolio. The covariance is a product of the correlation coefficient and individual return volatilities. In our case, this product is equal to 0.004. That is the average covariance of returns in the portfolio. As we have shown, the variance of a well-diversified portfolio is equal to this number, the average covariance of returns, which tells us that portfolio volatility is close to 6%. We can see that by starting with individual assets with 10% return volatility and diversifying, we are able to eliminate some of the risk. We reduced portfolio risk to close to 6%. We're not able to reduce it to 0 because some of the risk is common to multiple assets, but we're able to eliminate a significant fraction of risk from the portfolio. What if correlation was different? What if it was equal to 1 or 0? In this case, we would find different limits to diversification. As we can see from the graph, in case of perfect correlation, ρ equal to 1, diversification does not reduce portfolio risk. This is very intuitive. Correlation equal to 1 means that all assets move together in unison. There is no benefit in combining them into a portfolio. We cannot reduce the risk. Correlation equal to 0 gives us more room to diversify. Zero correlation means that the covariance of returns on any pair of assets is 0, and that tells us that in a limit, when the number of assets goes to infinity, the variance of portfolio returns will converge to 0. In this case, we can eliminate all of the risk in the limit as the portfolio grows in the number of assets. The curve in the middle is the case that we just explored, average correlation equal to 0.4. We can see that in this case, some of the portfolio risk can be eliminated through diversification, and some of it is left. Whatever is left is what we call systematic, non-diversifiable risk. Another lesson from this graph is that it doesn't take many assets to reduce risk of the portfolio significantly. Starting from a single investment and moving to 4 or 10 or 20 assets in the portfolio, we can realize most of the benefits of diversification. Going past 50 or 100 assets has little additional benefit.